Hey everyone, welcome back to Corporate Decoder, the place where we decipher those corporate filings so you don't have to. Today we are diving into a filing from FT Vest Annual Hedged Equity and Income Fund. Don't let the name scare you, we'll break it down, but spoiler alert, this fund is brand new, so there is no amazing history for us to see. Instead, we're going to see what they are about based on what's on paper. Basically, they aim for high income while trying not to lose your money, a classic promise. So let's see how they intend to make it work. This is a brand new fund just created in February of 2025 as a Delaware statutory trust. It's registered under something called the Investment Company Act of 1940, meaning it has to follow rules designed to protect investors. Importantly, they stress that this fund is only for people who can handle a high level of risk and don't need quick access to their money. The goal here is attractive risk-adjusted returns. They want to give you a nice income and some potential for long-term growth, while also trying to prevent big losses. They plan to do this by investing mainly in big US companies found in the S&P 500 index and buying insurance, something called a downside hedge. To protect against market drops, they are also aiming for a net income of 9% per year. But remember the catch, there's no guarantee they'll hit that target. This is their insurance plan. They're buying what's called a put option on the S&P 500. It's like betting that the market won't fall too far and being paid if it does. But it only really works if you hold your shares for a full year, called the designated period. This hedge won't cover all losses, even if it works as planned. Here's where they try to make that 9% income happen. They'll get some of it from dividends paid by the companies they invest in, and they'll try to boost the income by selling short-term call options on the S&P 500 or maybe on some of the individual stocks they own. This means they are giving someone else the option to buy the stocks at a certain price. If the stock price stays low, they keep the money from selling the option. If it goes up a lot, they might have to sell the stock for less than it's worth. They keep the money from selling the option. If it goes up a lot, they might have to sell the stock for less than it's worth. They might need to sell securities to settle an option position, which could result in the distribution of premium being classified as a return of capital. Important note, even though they are aiming for a 9% income, they might not always reach it, and some of the money they distribute to shareholders could be a return of the capital they invested. Let's look at the fees. And here things get a little spicy. The management fee alone is 2.65% annually, and then they add a distribution and servicing fee that varies depending on which class of shares you buy. Class A shares have a 0.75% fee, while Class I shares have a 8.25% fee, while Class I shares will be slightly cheaper at 0.97%. Those are hefty fees, so the fund needs to perform well just to break even. Class A shares also hit you with a 2% sales charge right off the bat, meaning you're already down before the game even starts. Here's how the expenses play out in real dollars. If you invest $1,000 in Class A shares and assume a 5% annual return, you'd pay $54 in expenses in the first year. Over 10 years, that's $3087 in year one and $329 over 10 years. This part outlines everything that could go wrong, and there's a lot to consider. First up, the fund has no track record. It's brand new, so there's no past performance to judge it on. Your money is locked up. They intend to offer tender offers to provide a limited degree of liquidity, but you can't just sell your shares whenever you want. Also, there's no guarantee they'll actually go through with the tender offers. They are using options, which can be risky. Options prices can be very volatile. If the fund uses options in the wrong way, it could lose a lot of money. The fund's success depends on the sub-advisor and a few specific people. If those people leave, the fund could suffer. There are conflicts of interest everywhere. The investment advisor, sub-advisor, and placement agent are all connected, creating potential conflicts when it comes to fees and selling shares. And to really drive it home, they tell you again that they might fail and you could lose all your money. Let's look at who's in charge. The fund is overseen by a board of trustees, most of whom are independent. Key people include David Lee, Robert Seyfert, and Gary Shagru. These guys are industry veterans with a lot of experience, so that's some reassurance. They provide oversight and make sure the fund is operating in the shareholders' best interest. On the inside, Michael Peck is the president, calling the shots on strategy. Chad Eisenberg is the treasurer, managing the finances, and Bernadette Murphy is the chief compliance officer, making sure they play by the rules. If you decide to sue the fund, you can only do so in Delaware, and you waive your right to a jury trial. So what's the story here? It's a high-fee, high-risk fund, aiming to generate income in a tricky market environment. The management team has experience, but the fund is new, so There's no track record. The big question is whether the potential income is worth the risk of losing money and the high fees you'll pay along the way. Here's my take. The FT Vest Annual Hedged Equity and Income Fund presents a compelling story on paper, a promise of high income combined with downside protection. However, the high fees create a significant hurdle. The management fee alone is a substantial drag on returns. The fund will need to generate very strong performance to justify its cost, and that's a challenge in today's market. The dependence on option strategies introduces additional complexity and risk. While the downside hedge aims to limit losses, it's not foolproof and can be affected by market conditions. The lack of liquidity is another key concern. With limited opportunities to sell your shares, you're essentially locked in for the long haul. Overall, this fund might appeal to investors who are primarily focused on income and are comfortable with a high degree of risk. However, there's no track record to base that claim on. But for most investors, the high fees, lack of liquidity, and reliance on complex strategies might make this fund a less attractive option. You might be better served by just buying dividend-paying ETFs, which will result in much smaller yearly cost, or by investing in an HYSA account. I'd recommend proceeding with caution and carefully weighing the risks and rewards before investing. Thanks for watching. If you found this breakdown helpful, give us a like, leave a comment and subscribe for more corporate deep dives.